Hey, welcome to chapter 16. We're going to look at investments. And you'll see some similarities here with what we went over in chapter 14, although this is the opposite side. Instead of us selling bonds and stock to raise cash, here we're taking our excess cash and investing in other companies' stocks and bonds. So this is investment. So we're jumping back across the equal sign on the balance sheet to assets. So let me go ahead and share the PowerPoint here. Let's jump right in. Maybe. There we go. So this chapter really can be split into two. It's two parts. It's the bond or debt investment side, and then it's the equity or stock side. So the first part we're going to look at is debt investment. And debt investments are when we as a company go out and buy other companies, primarily bonds. So it's not bonds payable. We're buying bonds from a company who is going to be their bonds payable. We're going to classify that really as three areas: held to maturity, trading, and available for sale. Now, there's a lot of different types of bonds. As you can see there, municipal securities, which are federally tax-free and state tax-free if they're from municipalities in the state in which you live in. And that can be classified as revenue or general obligation. So you got corporate bonds as well. Some of this can be convertible debt, commercial paper, but all this represents debt that we are investing in. And we categorize that debt in one of three ways on our books as an investment. We can call it held to maturity, meaning we have no intent to sell that, and we have to have the ability not to sell it, meaning we have to be financially stable enough and have enough cash to where we don't have to sell these investments in order to run our business. If it's not held to maturity, then it's either going to be trading or it's going to be available for sale. Available for sale is less liquid than trading. If it's trading, you're probably going to sell that in the coming days. If it's available for sale, it's kind of, well, I may sell it, I may not. So it depends on how you classify that and how we're going to report potentially unrealized holding gains and losses. Good little chart here because it lays out the three categories: held to maturity, trading, available for sale. Now, with held to maturity, well, actually with all three of these, you're going to amortize those bonds, right? If you've got where you have purchased something that is different face value, we've already gone through that in chapter 14, but here you're on the end that you're actually paying cash for an investment. Well, depending on what the interest rates are, you can go back and watch chapter 14 on that. Depending on what the interest rates are, it may be at a premium, maybe at a discount. And so we have to amortize that on our books as an asset up to face value, which is what we're going to receive back at the end. Not pay out like we did in chapter 14, but actually receive that cash at the end from our investment. So we may only pay $92,000 for an investment and get $100,000 back at the end. Unrealized holding gains or losses. You never recognize a holding gain or loss for held to maturity, because if the intent and the ability is there to hold to maturity, there's never a gain or loss. It doesn't matter what interest rates do. If you hold to maturity, you're going to get back to face value. All right, so you would not recognize a holding gain or loss based on what interest rates do during the service period. With trading securities and available for sale, now it doesn't say that here, but you are amortizing those as well. In case the trading end up being held longer than you think, and available for sale, certainly you may hold that longer than 6 months or a year or whatever the actual interest payments are that you receive in this case. But these holding gains or losses, you're going to compare what is the book value or what is the carrying value. The investment, what is that carrying value, the amortized carrying value compared to the market value of that bond, for example. And any gains or losses, holding gains or losses, because these aren't that you've actually sold it. This is your holding gain or loss is going to be recognized in net income for trading securities. But if it's available for sale classification, we're going to keep it on our balance sheet in OCI. Remember I said in that last chapter, we're going to look at that in this chapter. There it is, other comprehensive income. component of stockholders' equity. All right, so let's go through an example here of a held to maturity. Again, you have to have a positive intent that you intend as management team to hold this investment to maturity, and you have to have the financial ability to do that, meaning you don't need to cash. Very important. And we're going to use, again, the effective rate of interest method to amortize this investment. Good underlying concept there, lower right-hand corner. You know, thinking about those 5 principles you're supposed to be writing your gap paper on. Here's a good example of materiality. You can use straight line amortization if it's not materially different than the effective rate of interest method. Of course, you have to define what the materiality is. Let's look at this example, held to maturity. Z Smith Company, that's us. We're the ones making the journal entry. We purchased $100,000 of 8% bonds of Bush Corporation at a discount, right? Paying $92,278. So we paid less for this because what? We are getting an interest rate that is less than the market. All right, and there it is, 8%. We're going to get 8% on that $100,000, receive $8,000 a year when the market's paying 10%. So the market, had I bought from someone else, full value, $100,000, 10%, I would be getting $10,000 a year. But since I'm only going to get $8,000 a year, I don't have to pay the full $100,000. I only pay $92,278. Of course, the time value of money using the present value tables or Excel payment present value function will tell you that it's $92,278 based on 10% and based on the length of time, which is 5 years. All right, so there's my debt investment. It's an asset. Sounds kind of crazy, doesn't it? Debt investment is an asset. Well, you've invested cash. You've just taken cash out of the bank and put it into this is an investment to get interest and maybe even sell it if it's, of course, in this case, sell to maturity, you're not going to sell, but if it's available for sale or trading, you might sell it at a profit. If interest rates, if interest rates go down, people are going to bid up the price of your bonds that you've invested in. Very similar chart there and what you saw in chapter 14. But again, chapter 14 is about us bringing cash in to our business and thus being a payable or interest expense. Here you've got interest revenue because you bought other people's bonds, so you're going to have revenue coming in. But the concept is very similar. What you probably notice here, there is no discount or premium recorded. That's only when you have a liability. You're going to amortize this $92,278 up to $100,000, but there is no secondary contra or adjunct account. All right, so there's my $92,278. There's the cash received, straight 8% on $100,000. Doesn't matter if it's a discount or premium, whatever stated on your bond that you buy, that's what you're going to get in interest for. It's like what, 10 times, 5 years, twice a year. Interest revenue. Again, that's the market rate of interest, which is 10%, which we're multiplying 5% times $92,278. There's the calculation down at the bottom. $92,278 times 10% divided by 2, or it's just $92,278 times 5% for 6 months. 4614, so the amortization, again, what did I say in chapter 14? That's your plug number. If you were doing straight line, the interest revenue would be your plug number. But here, bond amortization, bond discount amortization, that's your plug. All right, and so then we have a new balance. In the next 6 months, it's 5% times 92,892 is 4645. Discount amortized. Now you're up to 93,537. See, that's going up. It's going all the way up to 100,000. All right, what's the journal entry look like? There's my first interest revenue receipt, $4,000 going into my bank account. There's the amortization of that $92,278. Again, 614 is being added to $92,278. It's going up. Eventually, it's going to be 100,000. There's my interest revenue. All right, at the end of the year, they're showing this at 12/31 because essentially you have earned that revenue for the last 6 months, or 5 months and 29 days, or 5 months and 30 days. So there's my interest receivable, which would have been cash, or it's going to be flipped around the next day as credit receivable and debit cash, right? But we got to recognize our amortization, our interest revenue in that year. And again, there's my amortization for 645. So now for the third 6-month period, I'm up to a carrying value of 93,537. And what does your financial statements look at the end of the year? Well, there's your interest revenue for 1 year, or 11 months and 30 days. There's my interest receivable. It's going to flip the next day. There's my debt investment, 93,537. That's my carrying value. All right, here's assuming they sell the investment during the middle of a period. I want to skip that. Thank me for that. Available for sale. So that's held to maturity. You notice there was no comparison of my carrying value to a fair value. Fair value is only in play for available for sale and trading, meaning we have to make a comparison of our carrying value to the market value, and then make a journal entry for a holding gain or loss. Because remember, if you're holding these bonds to maturity, held to maturity classification, then there's never a gain or loss if you hold a bond to maturity. Doesn't matter what interest rates do. All right, so we're going to use fair value here, and for available for sale, it's going to be recognized in OCI, other comprehensive income, which is a part of stockholders' equity. Any discount or premium is amortized. I didn't say that in that table a minute ago, but you have to do the amortization. You would on trading as well if you hold something that long, and it's possible that you would hold a trading designated bond beyond what you anticipated. All right, so here's very similar transactions. It's just some are designated as available for sale, some trading, some held to maturity. Same thing there, 10% bonds. Interest rate's 8%, market rate. So in order for us to get 10% from these bonds, we had to pay up for them, didn't we? $108,111 versus $100,000 face value. All right, and so then same process here. Interest revenue is going to be the market rate of interest, which is 8% times 108.11 divided by 2, or just simply 4% of 108.111 for 6 months is 43.24. The difference between the A and B, right? Cash received, interest revenue is going to be my amortization. That's my plug number. The amortization is always the plug number, the effective rate of interest method. Always remember that. So there's my new carrying amount. Then we do the same thing the next 6 months. And you can see instead of going up, that 108,111 is being amortized all the way down to 100,000. It's going the opposite direction, isn't it? But whether it's a discount or premium, in the end, after the amortization, it's 100,000 if you keep these available for sale securities that long. You're probably going to sell it before it's over, but not necessarily. The interest payment, or interest receipt, revenue, again, very similar, except the debt investment here is a credit, right? We're reducing debit balance up here. We're reducing that debit balance every 6 months. There's the next 6 months. Again, they call it interest receivable because it's December 31. We're closing our books. And the next day, you will actually receive your cash payment. All right, so what's changed now? We have to also, beyond held to maturity, because what we just did would have been identical if it had been classified as held to maturity. It just was a premium instead of a discount. So what's different? We compare this to fair value. So it's saying that they've determined fair value of these bonds is $105,000. Well, what's your carrying value? It's $106,732. So you've got to write down $1,732, don't you? Yes, as a holding gain. You haven't sold it. It's a holding gain. It's marked to market. So there's my loss. It's got to be a debit, doesn't it? All losses have to be debits. They're like siblings to expense. So there's my unrealized holding gain or loss equity. Equity is another word for OCI, other comprehensive income. And then this account called fair value adjustment for 1732. Fair value adjustment, that's an asset account. And it can either have a credit balance or it can have a debit balance. It swings both ways. It offsets your original investment because you don't want to make these entries against your original investment account. You want to do it in a contra or an adjunct account. And again, fair value adjustment can either be, you can either have a debit or a credit balance, depending on a gain or loss on your investment. So you want to keep that original asset balance clean. Much like when you buy property, plant, and equipment, you always record accumulated depreciation in a separate account, don't you? You leave the original cost whole. Don't bother that. All right. So here's a good example that they're showing the amortized cost, the fair value, and the amount of unrealized gain or loss. So they're showing the carrying value here, $293,537. This is for 2 bonds. And then the fair value. So they're showing a loss of $9,537. All right, so we need to make an entry for that. And the entry is debit against your OCI and equity for $95.37 and credit fair value adjustment. All right, what they're going to show you here is what happens when you actually sell one of those, maybe buy another. You've got to true up that fair value adjustment account. All right, so is that the same information? Is that a different one? Watson and Anacomp. All right, looks like it's the same one. So they sold these Watson bonds back on the prior page for $90,000, at which time it had an amortized cost of $94,214. So they actually sold it. It wasn't just a holding gain or loss that we've been looking at. They actually sold these bonds. And so you got a realized loss of $42.14. See, these other losses that we've been showing in gains are unrealized gains and losses. This is a realized gain or loss. You're recognizing both. But this is a realized loss. You've actually sold it. So we got to make that transaction just like you would have learned in 2010 and 3010. I received $90,000. I take it off debt investments at the amortized cost, right? $94,214. And then the difference is it's going straight to loss on sale of investments to my income statement. But then the question is, I've got Anacomp sitting there. And now at the end of the year, this 2015, Anacomp has an amortized cost of $200,000. The fair value based on interest rates is $195,000. So that says my fair value account should have a balance of what? $5,000 credit balance, right? $5,000 credit. But what does it tell you there? We don't have a T account. I don't have the ability to show you on a scratch pad here. That $5,000 balance we should have. If you've got a credit balance, then we need to make an adjustment for $45.37, don't we? Let me see if I can make a notepad here. Fair value adjustment, because I don't think they've got the T account on here. The balance was $95.37. So we need to make a journal entry for $45.37, don't we? That's going to show backwards, isn't it? The way these cameras are. $95.37 is our credit balance, but we need to be at $5,000 credit balance. So how do you get from a $95.37 credit balance to a $5,000 credit balance? You got to make a journal entry in red there a debit entry for 4537 to make this thing balance. The red is the bogey. You're forcing it to get to the general ledger balance that it needs to be. So there's the journal entry. Fair value adjustment. Again, your asset account. See, it swings both ways. And then there's my unrealized holding gain or loss equity. We take it to OCI because this, again, is available for sale. Now, the interesting part about this, I said there was 3: held to maturity, available for sale, and trading. Available for sale and trading is identical. The only thing that changes is where do you charge the holding gain or loss. Here, if it's available for sale, it goes to equity. If this has just been labeled trading, the only thing different about any of this is instead of an unrealized holding gain or loss equity, it would say unrealized holding gain or loss income statement. Straight to the income statement if it's trading. Because the belief is if it's trading, you are going to sell that sooner rather than later. Available for sale? Maybe. Held to maturity? No. All right, so that's what your balance sheet looks like at the end of the year. All right, trading securities. So this isn't any different than what we just looked at in AFS. Net income. Think about it. Trading, it's more liquid. You're going to sell it like a day trader. All right, so that's why there's only one slide. It's the same as AFS. All right, so that's half of the chapter. That is the bond side of the chapter, which is debt. And so when you read these exercises, and we'll go through those in the next video, and you see bonds, talking about investing in bonds, that is debt. I don't know why some students get mixed up on the exam. Bonds are not equity. Bonds are debt. You're investing in another company's debt. Stock is equity. Common stock is equity, right? All right, I'll make that point in the exercises that we work as well. Investments in equity securities. Think about investment in equity securities. You're buying another company's stock. Well, you're not going to get your cash back. You don't have to go out and sell that on your own. If you buy their stock through the open market, you're not selling it back, well, unless there's treasury. Unless they're wanting to buy that treasury stock, they may ask you specifically, but typically you're going to sell that on the open market. And so here we got equity, a little bit different than what we do with bonds. There are similarities because you are going to do a fair value comparison. What's the fair value of the stock versus what is your cost? You are going to do fair value. But they break it down into 3 categories. If you have 0 to 20% ownership, right? Common stock is what we're talking about. If you have 0 to 20% ownership in a company, that's considered not significant influence. See the term there? Not significant influence. Meaning if you own less than 20%, you probably can't control what goes on in a company. However, if it's a large company that's publicly traded, you know, what came out a few years ago with Wells Fargo and bank, and the issues they were having with commissions that people at the bank were making fraudulent transactions in order to earn a commission. And it all kind of blew up, and they ended up having to make a lot of changes there in internal controls and write-offs and so forth. But people said, well, wonder what Warren Buffett thinks about it. And say, well, what do they care what Warren Buffett thinks? Warren Buffett at the time owned about 10% of Wells Fargo stock. And you think, well, that's less than 20%, no big deal. But if you own 10% in the company, they care about what you think and what you might say. He's pretty well known. If you figure a lot of the stock that is so diverse as far as being disseminated among so many people, those shares really have no influence. So if you own 10, 15%, 20%, you probably can have a significant influence. This is just a guideline that GAP wants you to use, 0 to 20%. And if it's 0 to 20%, as we go through this process, there is no amortization. You throw that out the window. You don't have to worry about that anymore. It's over. Finally, right? After chapter 14 and halfway through 16. Your investment is your investment. You just have to compare to fair value. And you compare to fair value, and then you have a holding gain or loss. All right, what if it's 20 to 50%? Now you're starting to talk about significant influence. no matter what your company size is. Especially if it's a large company, it's definitely significant influence that you can control what goes on. And if it's significant influence, you have to use what's called the equity method, not the fair value method. The fair value method they're talking about is very similar to what you use with bonds. But the equity method is different. And we're going to see, we'll lay it out side by side, the difference between fair value method and the equity method in this PowerPoint. And then if it's more than 50%, you have a controlling interest, don't you? I worked for several years at Nuclear Fuel Service in Irwin. In the last couple of years I was there, maybe 3 years, I did all the consolidated reporting, which you're going to learn all about that when you take Dr. Freeman in advance. So between 50 up to 100%, these are wholly owned subsidiaries at Nuclear Fuel in Irwin that they own. They own 4 subsidiaries that had to be combined every month during closing. But for purposes of this class, you don't have to worry about it. Again, Dr. Freeman is going to take care of that in consolidated reporting in advance. But it's a parent-subsidiary relationship. You got the parent company like an NFS, and then they had Ecotech, RSI, LSI, WTG, had all these different acronyms. That all these companies were part of the parent company because NFS had a controlling interest. So you don't have to worry about that in this class. All we're going to talk about in this chapter, in this last half of this chapter, is the 0 to 20% category and the 20 to 50% category. 2 categories. All right, there's another chart that sort of lays out what we're doing here. And this has changed. And I could update the PowerPoint, except this PowerPoint, that's a picture. I can actually update the picture. But more likely they'll end up changing it back again sometime. So it's a fairly new textbook, but things change in GAAP and FASB and what they want to do. But what's changed is where you see 2 categories for available for sale and trading underneath holdings of less than 20%. Now, whether it's available for sale or trading, it's the same. They both go to gains, holding gains and losses go to the income statement. It's no longer on the balance sheet if it's available for sale. So that makes it easier. But when you work these exercises in Pearson, you're going to have to differentiate just like the textbook has between the 2. But I'm just saying for practice, for when you get your job and your career, you're going to find that these 2 are the same. So holdings less than 20%, that didn't change. The 20 to 50% didn't change. You're going to use the equity method. And then at more than 50%, use consolidated reporting. That's a good slide overall. All right, holding of less than 20%, fair value, market price unavailable, cost method. Let's skip that. All right, let's look at this example. Republic Corporation published, and we're Republic. We're the ones making the journal entries for them. They invested in the stock of 3 companies, Northwest, Campbell Soup, and St. Regis. There's the original cost. That's my equity investment. There's my journal entry. They group all that together. Debit equity investment, take it out of cash. Again, stock is equity. Don't read a problem like this and work it and say, well, this is debt investments. I worry about stuff like that when people at this point are making those mistakes. All right, cash dividend. And the assumption here when it says available for sale, they're telling you this is less than 20% up at the top. If it says available for sale or trading, it's less than 20%. All right, so dividend revenue is just like any company might invest in that's less than 20%. Debit cash, credit, dividend revenue. This is what you would have learned in 2010 and 2020 and 3010. All right, very straightforward. If this was the equity method, it would be different, but we'll worry about that here in a minute and how you treat dividend revenue. All right, so here at the end of the year, fair value, meaning they've gone out and looked up the value of their stock per share and calculated the fair value. So they have an unrealized gain loss, and mark to market says that we have a $35,550 loss. So we need to make a journal entry because we're using the fair value method, aren't we? Fair value for less than 20%, equity method for 20 to 50%. All right, so what does that journal entry look like? Well, very similar to what you did with bonds, right? The fair value method is the same concept, except this is equity, this is stock instead of debt or bonds. So we debit unrealized holding gain or loss $35,550 and credit fair value adjustment. So that fair value adjustment is an asset that's reducing the value, that is reducing my costs. So right there, cost is $718,550 less $35,550 gives me on my balance sheet $683,000. That's on my balance sheet. And we take that loss to where? To equity. That's what's changed. Now it goes to the income statement. But the book says equity. OCI, other comprehensive income. All right, they sold all their Northwest stock. So we have a realized gain, don't we? So we debit cash for the amount of the cash proceeds from selling that, and we take it off our books at cost, the $259.7, and then there's my gain on the actual sale of investments. Then we had the same issue that we had over there with the bonds, don't we? All right, you sold one of those, and by the way, in this example, they went out and bought some Continental Trucking at $12.75, $256,850. So now you got what? One of your companies you invested in is gone. You've added another one, but don't worry about it. You just have to ask yourself, what's the total original cost that's sitting there, and what's the fair value? And that says that my value should be $64,250. So I want to put this in a T account again, even if it's going to be upside down. Or I guess if you hold it up in a mirror, you can see what it is. But this says that we should have a balance of $64,250. And right now the balance is $35,550. All right. So how do we get from that credit balance of $35,550? How do we get from that credit balance? Right, remember that from the prior page? How do we get from there to $64,250? We're going to make an entry for what's there in the red, right? We're going to debit fair value adjustment for $99,800. And that will make the that will make the $35,550 be $64,250. Because that's my trial balance. Trial balance is what I circled in red. Previous period, and then where my trial balance needs to be in the current period. We always think we make entries and then see what our balance is. A lot of times in accounting, you figure out what should the trial balance be, and then you make a journal entry to make it be that balance. And that's what we're doing here. All right. Not that bad, is it? All right, so there's my journal entry. Debit fair value adjustment, $99,800. Now we've got a balance of $64,250, right? Which is what it should be. After we sold one company, we bought another one. That's what it should be, $64,250. And then that goes to equity, OCI, because this is available for sale. But again, available for sale and trading are treated the same now. It just doesn't say that in your textbook or the PowerPoints or the homework. All right, what about holding between 20 and 50%? So now the final part of this chapter is the equity method, because you can have significant influence. And think about it, if I can have significant influence, it almost starts to be like my company, doesn't it? And if it's more than 50%, it is your company in a lot of ways. Of course, you got your percentages there. You have to figure out what percentage of that company is yours. We can do consolidated reporting. But here, since we have significant influence, we are going to handle this a little bit different. You've got to take the investor's proportion of the earnings of the company you've invested in. That company, whatever their net income is, you've got to actually book that on in your financial statements in your investment account. And dividends actually reduce your investment account. Not revenue. You're impacting that investment account, that asset account with those two. So this is a great PowerPoint. This entire PowerPoint is from a different textbook than the one we use in Pearson, but it does such a good job. It's a Wiley PowerPoint. It does such a good job, that's why I put it in here. But it will help you a lot more than the one that's out there in Pearson. So on the left side here, you can see under the fair value method that we just looked at for available for sale and trading, all right, which they don't really differentiate now. Under the fair value method, how do you handle these transactions? Well, let's go down the left side and look. The initial investment, 48,000 shares at $10 a share. Debit equity investment, credit cash. All right, what does that look like under the equity method? The same. You start out with the T account with equity investment, don't you? All right, what about the next one? It says reported net income of $200,000. You don't care about that under the fair value method. The fair value method is all about comparing the value of the security, market value of the security against your carrying value. And once you determine that, that is your holding gain or loss. Now, think about what happens with net income or net loss. That in and of itself is going to drive the stock price, isn't it? So that's why you have one or the other. Under fair value method, you just compare the price of the bond or the price of the stock and make the appropriate entry. Under the equity method says, we don't care about fair value. We're just going to use that net income and take a percentage of that and book that against my equity account or my debt or, my equity account. All right, so if I've got $200,000, max company share is 20% or 40,000, then we're going to what? Increase that equity investment by $40,000. So we debit equity investment. Let me write that down here. So when we get to the bottom, you can look at my reverse T account. Equity investment. Start out with 480,000. We're going to add 40,000 to it, aren't we? You don't do that under the fair value method. Don't do that. So where does the credit go? The credit goes to my income statement. Revenue from investment. All right, what about the next one? It says 48,000 shares in many companies have a fair value of $12 a share or $5.76. So there you're comparing $5.76 with this 480. So we have what? A $96,000 gain under the fair value method, right? And there it is, fair value adjustment, 96,000, credit, unrealized holding gain or loss equity. Again, now that's considered what? Income statement. You don't have to worry about that for the exam, but that's just what's changed. All right, so what do we do on the right side with this market value? We don't do anything. It's one or the other. They're mutually exclusive. That's the difference between the equity and the fair value methods. If you're recording income up here, you don't record it there. Recording fair value here, you don't record it there. It would be like double dipping. Your net income is going to influence the stock price over time. It's apples to apples. Over the short term, it may not be correlated like you would like. All right, let's move on. Then we have a dividend. Cash dividend, simple. Under the fair value method, you debit cash, credit dividend revenue. Right? The same way if you invested in bonds and the interest revenue from that, you saw that in those transactions. What do you do about a cash dividend here? $20,000 cash dividend. Think about, because a lot of people miss this, think about what you would do or what happens. If a company I've invested in records a dividend, what transaction are they making? They debit retained earnings, credit dividends payable, and ultimately debit dividends payable and credit cash, don't they? So their retained earnings goes down and their cash goes down. So if I've invested in that company, yes, I'm going to get the cash, but the credit is going to be against equity investment. So many people think, well, it sounds like equity investment should go up. No, it goes down because they've liquidated their retained earnings into cash, right? So there it is. You debit cash, you're receiving the cash, but your equity investment goes down because their retained earnings went down. And their retained earnings that you've invested in is part of their equity. So there we put a credit in to the T account for $20,000. And then what happens for 2015? Here's another question about net income. In this case, it's a net loss. You don't care about losses. It's like up here, you didn't care about income. But we're going to record that loss there as a credit against my equity, aren't we? For $10,000. And that goes to my income statement. So that leaves the final one there, which is going to be no entry because it's another fair value comparison. If you look on the left side, the 48,000 shares at a market value of 528. Well, up here, that 96 had increased that 480,000 up to 576, hadn't it? So 576 to 528, what is that? $48,000. 576 minus 528. There's your 48,000 that we have to what? Record as a loss, because we have a $96,000 gain that went out there to my equity, OCI, which is really income statement now. So we got to reduce that in half. And of course, you don't care about fair value under the equity method. So that's a great slide. Make sure you understand that for the exam, because that's the best screen I've seen that compares those two. And really, if you understand what's going on here, you understand half of this chapter 16. All right, more than 50% controlling interest. You have your parent, like an NFS. You got your subsidiary companies underneath that. But you don't have to worry about that till you get to Dr. Freeman's advanced accounting class. I think that is pretty much it. The rest of this is similar. You don't have to worry about it. All right, so that is chapter 16. I will have another video out there for the homework, and we'll go through that. But again, we'll talk again soon, and I'll talk to you later.